Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make you a little money. My job is not just to entertain, but to explain, put in context. Call me at 1-800-743-CNBC. Tweet me at Jim Cramer. We want to have a conscience. We want to make a judgment about what the president's doing, whether or not it's right. When he does something outrageous, we can lament, complain, shrug our shoulders. But the one thing we can't do is sell the stock of NVIDIA because of President Trump's attempt to fire Lisa Cook, a Federal Reserve governor, for what might or might not be mortgage fraud. Yes, I know that sounded flip, but deal with me. On a day where the Dow gained 136 points, the S&P climbed 0.4%, the Nasdaq advanced 0.44%, all I heard today was people wondering if the market should be rallying when the president's trying to fire a Fed governor, which is supposed to be illegal. The cognoscenti want to say it's wrong. It's wrong for stocks to go higher, too, when the White House is threatening the Fed's independence. And look, I get that. I want an independent Fed, too. Federal Reserve may get it right or wrong, but historically, when your central bank is run directly by a president or a prime minister, you tend to get much higher inflation. That's just an empirical point. It's a given. But I am now going to commit sacrilege in front of you because, let's be honest, until this week, the vast majority of investors had never heard of Lisa Cook. They don't care that she hasn't been charged, not charged, but hasn't been charged with mortgage fraud, supposedly telling banks she had two primary residences when you're only allowed to have one. They don't even care how she votes, which is a last with presidential nemesis Jay Powell, the Fed chief. They think two things. One, this is all inside baseball to them. And two, the president does outrageous things every day. What's the deal? It's become the norm. Whether you think it's outrageously good or outrageously bad, it shouldn't be shocking anymore. Trump feels like he has a mandate to be outrageous. And given that his party controls both Congress and the Supreme Court, he can get away with practically anything, seemingly no matter how outrageous it is. To which I say at this point, when it comes to the prices of stocks, here I go, who cares? What does the firing or non-firing of a Fed official most people have never heard of have to do with the price-to-earnings multiple of the $4.4 trillion stock of NVIDIA going into tomorrow night's quarterly report? Again, I am not trying to minimize it. I understand why so many on Wall Street are worried that President Trump's trying to control the Federal Reserve. But at the end of the day, I don't see this stuff having much impact on your portfolio, okay, or on the most important stocks in this market. More importantly, I say own NVIDIA, don't trade it, regardless of what's happened with Lisa Cook's second mortgage application. I say I want an independent Fed, but even if it gets a little less independent, I believe that tomorrow night at this time, NVIDIA CEO Jensen Huang will have told a good story about how demand for chips remains incredibly strong because they're the bedrock of artificial intelligence. That's what I care about. I want our country to have a central bank that looks at the evidence and tries to do the right thing regardless of the president. But more important, I want to know the total cost of ownership of NVIDIA's new Grace Blackwell chip and whether it's still very moderate and whether customers will be able to generate a great return using it, something being called into question every day these days by a lot of the NVIDIA bears. Finally, I want the president to be less outrageous, if only because the Fed's about to give him what he wants anyway, lower interest rates. He doesn't have to fire anybody to make it happen. But I also want to see strong Chinese sales for NVIDIA. I mean, these things, I know they're totally unrelated. Let me put it another way. There have been so many shocking things coming from the White House that they're no longer shocking. At some point, this stuff gets priced in. Did the president take a cut of NVIDIA sales to China? Sure, but he did so after lifting ban on the sales, something that will make shareholders a fortune. Did he take a 10% stake in Intel in exchange for giving the company the money that it needs to keep growing? Yeah, and while it's unorthodox, Intel really needed the cash. That's left out. Yet somehow, every day, there are people who are shocked at what this man does. The more shocked you are, the more likely you are to sell stocks, even though most of this stuff has nothing to do with the market, and it's been wrong to sell stocks. Or to be blunt, do you really care if I'm concerned about whether a Fed governor got a mortgage unless the Justice Department files charges? My view on it means little. And look, for pretty much my entire career, if somebody told you to sell stocks because of a headline from Washington, you would have been dead wrong. We already went through this in Trump's first term. I'm just trying to figure out how to help you make money. And that means not paying as much attention to stuff as others would like me to do. I do care about Jay Powell. I like his independence. I like his sharp mind. But he has a term limit. The term will end early next year. President Trump will pick his replacement. Life will go on. Let me tell you a story about who I am and what I'm trying to do so you can understand why I'm not being cavalier and what has become my lifelong persona as Wall Street collar man. 2.5 months ago, I went on this 10-mile hike in British Columbia with my kids. Probably a mistake. They're really motoring. I try to motor, too. I'm a little older than they are. That's what happens. Kids are younger than you. On mile 5, I felt a pain in my ankle. It didn't go away. I really hurt myself, and this thing's been bugging me, so today I had the MRI, okay? What happens when I get an MRI? Okay, well, first, the person who guides me in the MRI, he doesn't guide me in and say, hey, I like that gal in you. He says, okay, what am I buying here? And I said, well, I like Boeing. Well, how about NVIDIA? Well, I go, okay, Solana? I said, all right, I like the Bitcoin. I like the crypto. Solana's good. I like Solana. What does the person who straps me in the MRI want to know from me? Does he ask me, do you want Beethoven, Brahms? I don't know. No, he wants to know whether I still like Palo Alto Networks. I just bought some for the trust. It looks real good. And I like Boeing, too. And we finished the MRI, crowded elevator. A terrific woman next to me says, money man, what do I do with the NVIDIA? I told her to own it. Don't trade it. Regardless of tomorrow's quarter. Did anyone ask me about Lisa Cook? I wouldn't tell everyone I thought it was outrageous that Lisa Cook may lose her job because she's may be charged or may not be charged with having 2 primary residences or maybe not having 2 primary residences, and that therefore the Fed's not as independent, and therefore you should sell NVIDIA. But that's not how it works. They wanted to know how to make money. Am I craven in my insistence of trying to help these people rather than arguing about policy? Am I less of a thinking person because I didn't direct them to the angst about the Federal Reserve's independence? At the end of the day, at the end of the very day, I just don't want to scare anyone from what could be a good stock and a good stock market because of the feelings I have about the Cook imbroglio. So I keep my opinions that aren't relevant to stocks to myself unless asked directly about them. You don't come to me for a civics lesson. You come to me to ask me if you should buy or sell NVIDIA. I say buy, or at least hold. You want to know whether I think Apple should buy Perplexity. I don't talk about it anymore because I've said it too many times. But I don't mind this. You know why? It's not my lot in my life. It's part of my life's joy. So here's the bottom line. As long as I have this job, I'm going to keep trying to help people make money in stocks. If someone had asked about Lisa Cook, I would have given them an answer about Fed's independence. But you know what? They didn't. They want me to help them make money. And I am, in the end, their obedient servant they want to hear about stocks, not inside baseball about the Fed. And the viewers are my real bosses. And that's who I play for. And that's what I do. Kurt in Illinois. Kurt.
Booyah, Jimmy C.
Booyah, partner. What's up?
Hey, I like to say fly, Eagles, fly.
You betcha. Howie Roseman, the best. Loves my wife. Fantastic. Go ahead. My wife and Howie are business partners. You know, we make a joke about that. Okay, go ahead.
Yeah, I'd like to ask, what do you think about this pharmaceutical company? They got approved for a drug to help with memory loss back in July. It's a little company, a pharmaceutical company out of Indianapolis, Indiana, called Eli Lilly.
Okay, the memory loss is not that important, Kurt, because it's just a very hard thing. I mean, actually, if you want memory loss, you buy Amgen, because Repatha is doing really well in the memory loss category. Here's what you need to know. That Lilly thing this morning comes out, and I'm like, I'm going with Jeff Marks, and I'm like, I'm saying, listen, this is a really big deal. But meanwhile, it gives me the 7th position in the draft. That's what I need. And I say the stock was up at 12. I said, read the first test versus the second test. The first test is a lot about if you are just wait. The second one's got diabetes. This is the pill, okay? Bear with me. It's the pill. If you strip out the people who are very hard to lose weight, this pill is going to lose you, I think, between 12 and 15 pounds. And that's why Lilly, instead of being up 12, went up 40. Okay? I was surprised nobody asked about Lilly today. It's kind of odd. All right, you want to hear about, guess what? People want to hear about stocks from me. They want to talk second mortgages and primary residence. I'm all over it. Now, on Mad Money tonight, TJX just broke out after the quarter. So can the off-price retail? I'm so fired up. I don't know why. I'm digging into this story of the TJX, okay? And then from cotton to coffee, what the hell? Why isn't the price of corn and everything about it lower? Well, I don't know. I think it's going insane. So I'm going off the charts to get a better read. And Switzerland was hit by nearly 40% tariff on products sold in the U.S. What is that about? I'm going to turn to a private player in the space. Breitling. To get a better sense of how this might impact the company's business. Look, I'm happy to talk second mortgages. I have a couple of them myself. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Last week, we reached one of my favorite parts of the year, the retail portion of earnings season. Hearing from Home Depot, I told you that quarter was good. Target, Walmart, not bad. And my favorite, TJX, the off-price specialist that owns TJ Maxx, Marshalls, Home Goods. Those stores look very sharp right now. And a couple of other discount brands. I like this one so much, we have a big position for the Travel Trust, and it's been a phenomenal long-term performer. But when TJX reported near the end of May, the stock got hammered. It was trading around 135 before the numbers hit. The stock drifted down all the way down to 120 at multiple points this summer. I think it was pushed down in some parts, but there were many short sellers. Even by the end of July, it was still sitting in the mid-120s. Things changed when we got the weak July labor report on August 1st, which came with some major negative revisions for prior months. So negative that the president fired the head of the Bureau of Labor Statistics. But while the White House didn't like those job numbers and a lot of more discretionary retailers feared them, they were fabulous for TJX. Investors figured that with a much softer labor market, consumers would be more inclined to go bargain hunting, and nobody does bargains better than TJX. And that's why the stock caught fire this month and has been nothing but buy. Normally, when a stock runs up into earnings, that's not necessarily a good thing. TJX, in particular, tends to sell off in response to good numbers, and action in the stock had already set a high bar. Yet, when TJX actually reported Wednesday morning, they delivered a gem of a quarter, though enough to send the stock up more than $3.50. Not only did the revenue come in higher than expected, up 7% year over year, but they had accelerating revenue growth in each of the four divisions. That's Marmaxx, which is the bulk of the company, TJ Maxx, Marshalls, and Sierra. Then there's that Home Goods that I mentioned, possibly on fire. Third is TJX Canada. They're making a lot of money there. And fourth is TJX International. Very good business, which really should be called TJX Europe and Australia. Every one of these components had accelerating revenue growth, which we also call ARG here. And Wall Street can't get enough of that ARG goodness. At the same time, TJX's total comp, same-store sales, which is how we really measure retailers, grew by 4%. Wall Street was only looking for 3.3%. Some of that was from the domestic TJ Maxx and Marshalls, but a lot of it came from the Canadian business, which for some reason was up 9% same-store sales growth. That's incredible. Analysts have been looking for 5%. Just as important, TJX had a better-than-expected gross margin of 30.7%, up 30 basis points year over year. Many retailers are having pressure in their margins. Their pre-tax income was up more than 12%, also better than expected, and they posted a 9-cent earnings beat off a $1.01 basis. That's nearly 15% earnings growth. Retailers are hurting. They're not giving you that. Oh, and TJX's operating cash flow would trounce the estimates, coming at nearly $1.8 billion. Wall Street was only looking for $1.4 billion. Guidance? TJX has a reputation for being on the conservative side with its forecast. That's one reason why the stock tends to get hit in response to earnings, even though we know from experience that these guys are expert practitioners of what we call UPOD. U, under, P, promise, O, over, and D, deliver. Under, promise, over, deliver. This time, management offered an in-line to slightly soft outlook for the current quarter, but they also raised their full-year forecast across the board. That was unlike them. For the current quarter, the TJX guided for slightly higher than expected revenue, but their same-store sales forecast was a little light. That's like them. And their earnings forecast was 4 cents lower than expected in the midpoint of the range. So that's really like them. But again, these guys tend to be very cautious with their guidance. That's just how they play it. When TJX reported in May, the stock got clobbered because management guided to 2 to 3% same-store sales growth next quarter, and the earnings per share of just 97 cents. 3 months later, turned out to be 4%. $1.10 per share. With this latest quarter, TJX has now exceeded the high end of its own quarterly earnings guidance for 10 straight quarters. UPOD. So when the guidance for the current quarter once again came in light, everybody realized that's management simply sandbagging us with low-ball numbers. Sometimes, though, the business looks so good that even this cautious management has to raise numbers across the board, and this was one of those times. For the fiscal full year, TJX is now talking about 3% same-store sales growth, up from 2 to 3% in the previous forecast, and they raised their earnings guidance by a stunning 16 cents at the midpoint. Crucially, that's 7 cents bigger than the earnings beat these guys reported, meaning this was a genuine beat and raise, not a lot of, one of the kind of ones that we should just forget about because they were manufactured. And if you listen to this conference call, which was dry, unfortunately, but that's them, you got an even better story. Here's how President and CEO Ernie Herrmann put it, and this is about as exciting as this guy ever gets. As we have seen through so many retail and economic environments, consumers were drawn to our excellent values and brands. Customer transactions were up at every division and drove our overall comp sales increase. Going forward, we continue to see market share opportunities across each of our U.S. and international divisions. Ooh, end quote. Now, with TJX, one of the things I'm always watching is the company's availability of merchandise, meaning how easily they're able to get their hands on quality product that other retailers weren't able to move, and they're stuck with trying to bring in new stuff. They can't till this other stuff goes out. Remember, the whole business model here is that TJX buys excess inventory from other retailers for a fraction of what it's worth. Those retailers have no choice but to sell. They need to move the old merchandise before they can bring in the new merchandise. Or there may be like a Kohl's, which is like, hey, listen, we got to raise some money here. And that's how TJX can offer you such incredible bargains. But it only works when they can get their hands on quality product. Remember, TJX actually makes very little product itself. It buys from others. The others are the ones that pay the tariff, not TJX. On this conference call, CFO John Klinger sounded almost giddy about the merchandise that he's finding. And he's, quote, confident that availability of merchandise will continue to be outstanding, end quote. He goes on to say, quote, we are well positioned to flow fresh assortments to our stores and online this fall and holiday season, end quote. It's that excess inventory of others that allows TJX to give you the treasure hunt experience people love. We have a TJX right next to us, which I love to check out all the time, and you never know what you're going to find there. I mean, here, just like let me consider these pants. Well, yeah, let's just cut it. Now look at these, okay? This is my size, 32-30. I'm looking pretty good. This is a slim boot king. I don't know what that means, but I like it. Buffalo David Bitton. I guess that's great, but it doesn't matter. Here's what's great, okay? What's great is 109. Well, here, come here. 109, and what did I get it for? $19.99. Does that tell the story better than anything I could possibly say? And these will look great. Now, the fact is I live and breathe and sleep in Brioni. I don't know what I'm going to do with them, but I like the price. Okay, anyway, this is a key factor in the value that the company is able to provide their customers. As CEO Ernie Herrmann stated on the earnings call, I am convinced that the consumers will continue to seek our value and that we remain a very attractive option for consumers seeking great brands, fashions, and quality merchandise at compelling prices. Our customer surveys tell us that our value perception remains strong, and we are laser focused on keeping it that way. Yeah, I put this belt is also from there. And I'll tell you, this belt, I saw this belt in Italy, I swear to God. And like I saw it next door, and it's cheaper here, believe me. Customers see value at TJX because they're buying quality merchandise for less than they can get anywhere else. Contrast that to other retailers, like the dollar stores, right? When you go there, the prices look cheap, but for lower quality goods, go to dollar store. I think you're buying things for much more than they cost. No bargain. No bargain, except maybe in the candy aisle. But even there, I got to tell you, the boxes seem like they're shrinking, or maybe there's just fewer residents in the box. I got to do some counting. In response to all these positives, TJX stock gacked up last Wednesday, setting a new all-time high in the process. Initially rallied 8.1%, for heaven's sake. But then the stock got hit with some profit-taking, finished up just 2.7%. Hey, by the way, since then, TJX has given back more gains to the point where it's now up less than $1.50 from where it was trading before this remarkable quarter. You're practically getting it for free. So let me give you the bottom line. And by the way, I do like these pants. Anyone know who Buffalo is? I mean, I don't know. Could be anybody. This is an excellent outcome for TJX and a vindication for everyone else who's defending the stock all summer, including me and my compadres of the CNBC Investing Club. $19.99. Can you believe it? I'm crushing it. Consider the facts on the ground in retail. Everything from the tariffs to an incredibly value-conscious consumer, I'm betting TJX has more to run. I wouldn't be surprised if this stock becomes a semi-permanent resident of the new high list for the rest of the year. And believe me, in my less let's say in my less prudent times, I'd put these on right now. Mad Money's back after the break.
Coming up, what can cattle, corn, and coffee tell us about the market? Cramer's going off the charts and taking a look at the trends in commodities and what it means for your money. Next.
Look, this is really important. We've had a lot of things be roiled in the stock market. because of the commodities market, and yet I haven't addressed it enough, so you don't understand. By the way, it's also the same thing in the supermarket. And while that's not about stocks, it's about you and what you have left to invest in. So lately, it feels like the entire agricultural complex has just gone insane, with corn rolling over while cattle and coffee prices soared to new highs. So tonight, we're going to go off the charts, take a closer look, with the help of my go-to person, Carly Garner. She's a brilliant technician who's a senior commodity strategist and broker at DeCarly Trading, as well as being the author of the DeCarly Perspective newsletter. She is the person we like to talk to about things that I, frankly, am not specialized at. And in her view, what we're really seeing now is the tragedy of the farming business. For years, we had a pretty massive bull market in grain that drove corn prices to $8 per bushel. Farmers made big investments in better equipment, like the stuff that we talk about all the time with AGCO, with Deere. New technology, more acres planted. But when you boost production, that ultimately leads to lower prices, which is what we're seeing right now. This is why I always tell you that commodities are inherently boom-bust. There's no escaping it. Fortunately, Garner thinks this downsizing in corn, the downswing, probably in its first inning. Why? Take a look at the monthly chart of corn futures. As Garner sees it, corn is repeating the previous bear market that it went through in 2014. Pretty good comparison. Back then, corn market was coming off two euphoric runs, up to $8. The bulls managed to put together a $1 rally earlier in the year, but then corn rolled over, plummeting to the low $3 range. How does that stack up with right now? Garner points out that corn was coming off an incredible rally to $8 again back in 2022, though it already pulled back hard from its highs just like 2014. Earlier this year, corn also rallied $1 before moving sharply lower. This time she expects less pain, but still sees corn coming down to its 5-year trend line of $3.75. Okay, so it's or possibly even $3.50. In other words, but with corn a little above $4, we could be pretty close to the lows. If we keep following the 2014 pattern, Garner says corn prices should hover between $3.50 and $5 for the next couple of years. Historically, $5 is a major ceiling for corn. If it breaks out above that level, you tend to see explosive moves to the upside. But mostly it stays below $5. Look, as an aside, does anyone out there actually feel they're getting a break in the price of anything? Why aren't some prices of commodities connected with corn going down? Why aren't things so darn expensive in the supermarket? Well, the answer, like so many things having to do with inflation, it's complicated. For example, while the grain producing business is in a slump, cattle producers are enjoying the best pricing in their history, the history of the product. You probably noticed the astronomical increase in the cost of beef. We had Wolfgang Puck on today, big restaurateur, talking about it. It's terrible. Some of that's because we closed the Mexican border to the meat trade thanks to a screwworm infestation. Some of it's tariffs on beef imports. Some of it's the weak dollar. And some of it is simply supply. In America, we have the smallest herd of cattle since the 1950s. That's shocking. Is it any wonder why the stock of Texas Roadhouse, a huge meat buyer for its $11 steak dinner, didn't make its quarter? It's because of this. Keep in mind, the cattle market trades limited hours without overnight session and with less liquidity than most commodities. And that's why Garner believes it's a market ripe for price exaggeration when speculative fervor gets out of hand. And she thinks that's exactly what we're seeing. This is what you're seeing here. This is the corn futures. We're going to go to basically steak. Just imagine it's steak, okay? Look at the monthly chart of cattle futures going all the way back to 1995. All right, so we've got a long-term view here. Garner thinks cattle prices are following the 2014 blueprint, too. In 2012, the cattle market achieved fresh all-time highs, then consolidated for a few years before making a parabolic move. That's parabolic, right? I always tell you these things collapse. Well, this one that collapsed under its own weight. Boom, right down like that, okay? Now, how does that compare to right now? In 2023, cattle prices rallied to an all-time high. Go back to 23 here. To all-time high, with the relative strength index following the market into overbought territory, just like 2012. After a few years of consolidation, cattle prices then broke out explosively to the upside. We've never seen a move like this. Is steak, people. This is what's happening. This is why you see your steak up huge from even what is a couple of weeks ago. Right now, the chart's pointing toward $3.75 feeder cattle as a potential blow-off top tipping point, and the options market seems to agree. Garner says that call options are already pricing precisely such a move. This is a mere 10 to 15 cents higher than where feeder cattle are trading right now. At any other time in history, 10 to 15 cents, that'd be a substantial move. But this is the most volatile cattle market in the history of cattle. Garner expects the cattle bull market to run out of steam soon, especially when you look at the insanely overbought levels, the relatively strength, and it is pretty amazing, the RSI. We haven't seen anything close to this since cattle prices peaked in 2014. At the time, the fundamental narrative was as overwhelmingly positive as it is today, but that didn't prevent the cattle market from giving back the entire rally over the next 2 years. Garner's betting that scenario will repeat itself, which means eventually we could be looking at $1.25 cattle. I know that's hard to believe, but if history's any guide, Garner's on the right track. And if she is on the right track, I got to tell you, after a weak quarter the Texas Roadhouse, I believe is happening right now, that's the name to be in. That's why our Charitable Trust continues to buy it. Next, I want you to check out the weekly chart of the feeder cattle futures with the CFTC's Commitments of Traders report. And it's data that tells you how various types of investors are positioned. Here, Garner likes to look at the green line. Okay, so I know the lines seem like they're all blurring here, but this is the green line. This represents large speculators, meaning money managers. Right now, the large speculators have gotten wildly net long in the feeder cattle market, with a net long position of nearly 30,000 contracts. Prior to this year, Garner points out they'd never had net long by more than 17,000 contracts. Basically, she thinks everybody who could go bullish on cows has already done so, and it'll be hard to find fresh buyers. Plus, if these speculators liquidate all at once, the price of beef will collapse just like 2014. Look, this is a parabolic move. Again, this is why when you go to the supermarket, you see what you do. And she thinks it's about to end. Be very bullish for our country. Finally, let's talk coffee. According to Garner, if not for the existence of natural gas futures, coffee would be considered the commodity widowmaker. Okay. When you look at the monthly chart of coffee prices, we've seen high volatility over the past couple of years as the market worked through supply issues caused by drought and exceptionally hot temperatures in Brazil, floods in Vietnam, and the aftermath of low coffee prices before 2020. Before the pandemic, we had years of low coffee prices that forced many growers to shutter the business, which is why coffee prices have surged now that we're experiencing supply disruptions. Again, though, when it comes to the ag complex, Garner reminds us the bull markets are the exception. Bear markets tend to be much more in common. For example, right now we're experiencing the only fourth legitimate bull market in coffee over the last quarter century. Here we go again. Garner points out that the previous three coffee bull markets made dramatic late spring or early winter highs, but ended after a spectacular August rally failed to maintain pricing. 2011, 2014, 2022, coffee prices roared in August and then rolled over, although in 2014 it took an extra month before it fell apart. Garner's betting this time will be no different. Coffee surged to unfathomable heights early this year when it experienced a temporary setback before putting on a magnificent August rally. Yet history says these August coffee rallies just do not last. The last three coffee bull markets were followed by 50 to 65% corrections. If the current rally behaves in line with the past, that's going to be brutal. Now, that is very good news for Starbucks, another stock that the Charitable Trust owns. Although, I got to tell you, that stock has been made weak by the coffee prices, but there's so many other factors involved that I think coffee prices are actually a smaller part of what's wrong with the stock than, let's say, a lot of other things. Here's the bottom line. The charts interpreted by Carly Garner suggest that corn prices are almost done falling after a long downswing. Cattle and coffee prices could be about to peak after major rallies. At the end of the day, commodities are inherently boom and bust, and nothing's more commoditized than the ag complex. I care, of course, more about the stocks and their impact, and at these extremes, the impact is for real. Okay, let's take some calls. Let's go to Tony in Florida. Tony.
Hey, Jim, welcome back from your vacation. Hopefully you're well rested and ready to go.
I am. Thank you so much. What's going on?
I just bought this stock a couple of months ago, but I've been going to this club for years, and it's always packed. And I bought a couple of times on the way down, and it's 12% of my portfolio. Can I buy more Costco or hold on to it?
I want you to buy more Costco here. I was actually going back and forth on Costco. What's the right level? It is under 50 times earnings right now. I feel very good about buying some Costco. Almost actually pick some up for the Charitable Trust. But I'll tell you the truth. it's so far above my basis that I don't want to tempt fate. I think you got a winner in Costco right here, right now. Remember, they can pass on the price of beef because they are about the membership, not about the price of beef. The charge distributed by Carly Garner suggests that corn is likely reaching its lows, while coffee and feeder cattle will peak soon. Another cycle in the boom and bust world of commodities. Remember, they do relate to both you at the supermarket and to you in your portfolio. Now, much more Mad Money ahead. Watchmaker Breitling is partnering with the NFL to become the league's official timepiece partner. I'm getting a sneak peek at all the exciting releases the company has planned with the CEO ahead, of course, of this season, which actually begins in about 8 days. Then President Trump wants to tariff furniture companies due to national security concerns. But is this really an industry that needs to be controlled due to national security risk? Or is this just the president's nostalgia for an American industry that once was like I had? I'm digging into the situation, sharing where I come down. And, of course, all the calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Sometimes we like to take a step back from covering the names that make a lot of headlines. Shine a spotlight on a business that you don't hear about every day. Take Breitling, the privately held Swiss watchmaker that's been around for over 140 years. My dad loved to wear Breitling, although his were all fakes, fresh off of Canal Street in Lower Manhattan. No. Now, there's a lot we can learn from a company like Breitling, from the state of the luxury watch market to the impact of tariffs in the industry to the news that they're about to become the official timepiece partner of the NFL. And it matters when you're the official timepiece of a major sport. So let's take a close look with George Kern. He's the CEO of Breitling. Mr. Kern, welcome back to Mad Money.
Thank you very much for the invitation, Jim.
I know that the NFL is near and dear to my heart, but it's near and dear to it's the only thing that the ratings still keep going up. You have a partnership. Tell us how important it is to your company.
It's absolutely fundamental. The U.S. is by far our number one country. We're selling roughly 23% here in the U.S., so it's a very important market. The NFL is the ultimate American sport. It has all the values which also respond to Breitling. It's a team sport. It's strategic. It's tactical. It's male, female. It's a family gathering. Over 100 million people are watching the Super Bowl, and we are the first luxury brand partnering with the NFL, and we're very proud about that.
Okay, so tell me, people are going to say, well, listen, I love the NFL. I don't want an NFL watch. My team is the Jacksonville Jaguars. Can I get one that has my team?
Absolutely. We will be offering, starting tomorrow, for every team, a specific watch, actually two. So the 32 teams will have a specific watch available for the American consumers, and you can buy as many as you want. I know what your most preferred team is. You can say it. I'm not going to say it, but we have a watch for you.
All right. Now, I want people to know, look, Breitling, one of the things I love about it is its fantastic style. I think it represents a kind of value that is different from a Dollar Tree value. It's a timeless value. Now, these watches will be timeless, but they're not inexpensive for most Americans.
Yeah, no, our average price today is $7,200 but we start at roughly 3.5. And by the way, also for the NFL, one of the series will start at 3.5. So we have 2 price points for the NFL watches. To bring in and as many consumers as possible.
Okay. Now, one of the things I like about Breitling from when I first met you is you made a commitment to brick and mortar in the United States. You made a commitment to hiring in the United States. You made a commitment to spending a lot of money in the U.S. Yet somehow I look at the tariffs from the president. I find them quizzical. Maybe you can explain to me why suddenly Switzerland's been hit with some big tariffs.
Yes, we are a little bit under shock, still under shock. Switzerland is the country which is investing the most per capita. We are only 8 million people country. We invest the most. We employ 450,000 people here in the United States. We pay the highest wages, an average $150,000, because we have pharma, we have watches, we have high tech. We are sister country of the U.S. Our constitution was inspired by the U.S. Constitution. Something went terribly wrong in that famous phone call between President Trump and our president. This has to be fixed, but I'm confident that it will happen.
Well, I think so. I mean, your stuff is revered, but you're also a company that I think, I was witness the NFL title, that is recognized as the brand in America of the luxury brand. That's how I feel about you now.
No, absolutely. And it's very interesting when I go through the customs, the agent is asking me, for who do you work? I say, for Breitling. And he believed we're an American brand. We have been associated to aviation. We have been supporting all public, CIA, FBI, the White House. We are now supporting also the 250 years anniversary, U.S. anniversary, also preparing a watch, a limited series in that context. And we have these strong links in the U.S., and we want to continue. And we are hopeful that this tariff issue will be solved.
I bet you it will. Now, let me ask you, we see the NFL, it's all over the world now, these games. Does it matter? Do you think there's a fan base? I went to a beautiful game in London. I mean, everyone was wearing all sorts of different colors. They all liked different teams. I tried to tell them, listen, this is an Eagles-Jaguar game. And no, it's an NFL game. So do you think that when they do it in Brazil, when they do it in Frankfurt, will this impact your company?
No, absolutely. And as you said, the NFL is spreading around the world. There will be many games in Europe, but also elsewhere. There are hundreds of millions of viewers for the Super Bowl in Europe and in Asia, and it's so impactful, and we love it. We will have all the decorations, all our stores will be decorated with the NFL. It's our single biggest investment as a brand worldwide.
Well, look, I wish you the best of luck with a sport that you're absolutely right is the American sport, but it's going to be the worldwide sport because it's so much fun. And yes, I am a proud viewer. I've had this.
We have the watch for your team. We have the watch for your team, Jim. We have your watch.
Oh no, I'll be it. Believe me. George Curtis, the CEO of Breitling Private Company. By the way, in China, you're still holding up. Your sales are still holding up.
We're getting there.
All right, fair enough.
We want to sell in the States.
It's not a big market.
We sell in the States.
You're here. They have money back after the break. And then the lightning round is over. Are you ready? Skeet that down the red curtains. And let's start with Paul in New Jersey. Paul.
Booyah, Jim.
Booyah.
First, a big thank you to you, Jeff, and the rest of your team for all you do for the club. It's very much appreciated.
Thank you, man. We're working. How can I help you right now?
Yes. So, I used to like Carrier Global, and if so, is now a good time to start a position?
The stock's too low. You got to do some buying. I absolutely totally agree with you. Hey, by the way, on our club meeting today, we do that 1020. It was Boeing, and we said go with the Boeing, go with the G. It was a very good call. You got to watch the 1020. It's really important. Let's go to Nicholas in New York. Nicholas.
Hey, Jim. Booyah. How are you, my friend?
I'm doing well. Thank you for asking. How about you?
All right. Pretty good.
Excellent.
I was just calling in today to ask you your opinion about Oklo. I mean, I did a lot of research.
Okay, so Oklo's the stock that changed my mind for this show. When it was at 30, I just said, I can't take it anymore. Every time you get a good headline, the stock goes up, and that's exactly what it has. And there's more good headlines ahead. Buy Oklo. Let's go to Mike in Pennsylvania. Mike.
How you doing, Jimmy? Listen, Jim, when the president was his first term, the pandemic started, and he decided that he was going to get companies to switch gears and make vaccines and everything where we didn't have to depend on foreign countries. Kodak.
I like that. Okay, so here's the problem with it. That's a pure spec stock, okay? And why do I say, well, it's a pure spec? It's a company that, does not make any money at all and is losing boatloads. If you like it, accept the risk. But otherwise, no go for me. Let's go to Johnny in Washington. Johnny.
Hey, Mrs. Cramer, booyah from Tacoma, Washington.
Wow, you come in fired up, and I like that. I like how you play. How can I help? Hello? Well, I like that. I like the state of Washington, but I also like stocks. It looks like we lost him, but that's okay. Johnny, you back? Here's Johnny. No. Okay, let's go to Pramila in New York. Pramila.
Hi, Mr. Cramer. It's so good to speak with you.
I'm glad you called.
I'm a big fan of yours. I watch your show regularly every day.
Thank you.
Thank you so much for imparting your knowledge. Today, my question is, what's your view on TPL?
See, I'm not positive on oil right now. That was one of our favorites last year. I'm going to say, you know what? We're just not going to go there. It's just not right to own the oil and gas right now. They're just on the wrong side of the trade. Now I'm going to Karen in Kansas. Karen.
Hi, Jim. This is Karen from Kansas.
All right.
I'm a long-time viewer and first-time caller. Thank you for all your stock market education.
Thank you. Thank you very much. How can I help?
I would like to add a utility stock to my portfolio for growth and dividends.
Sure.
This stock is down 31% since the January California fires. Is this stock a buy? Edison International, EIS.
Yeah, I am going to have to punt on that. You know, look, I just think California's too hard. I just really do. I think it's too hard. Even for Patty Poppy, it's too hard. It's too hard for Patty Poppy. It's too hard for me. Now, she wouldn't say it's too hard, but I think it's too hard. And I don't want to, I think it's a little higher risk than we think. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
If we wipe out an industry in this country because it's cheaper to make the stuff overseas, is that a national security risk? Or are we just nostalgic for a different time when America was still a manufacturing powerhouse? Last week, the president talked about an ongoing 232 investigation making furniture. 232, mind you, being a national security kind of tariff the president has control over. The president's apparently worried about supply chain risk for furniture, something that seems a little strange, but we're in a Cole Porter moment. Anything goes. I've been a huge believer in the need to bring back certain industries from overseas, assuming they're integral to our national defense. That's why I've been so adamant that our country needs its own supply of rare earth minerals rather than being hostage to China. You need this stuff for everything from electric batteries to our own fighter jets. It's why I favor tariffs to prevent other countries from dumping steel or aluminum on our market. I'm a fair trader, not a free trader. It's why I want to see semiconductors of the highest order made here. All those have a major national security component. But furniture? I don't know. I remember when we were the kings of furniture, first in Grand Rapids, Michigan, and then in High Point, North Carolina. The monuments to chairs and tables were the envy of the world. I'm nostalgic, too. Unfortunately, our country is an expensive place to manufacture furniture. Our manufacturers, with the exception of Ethan Allen, have moved on to other cheaper places without much quality sacrifice. That way, they can get you the best quality goods at a fraction of the price. Some call it democratization. It's the bargain of globalization. We sacrifice some jobs here in exchange for cheaper goods. The president wants to get those manufacturers back. So do I. I think they might want to come back rather than be tariffed to the point where the wares become too expensive. But some of these industries aren't probably going to come back. Companies would tell you that you can't just invent a workforce that knows how to make upholstery. That ship sailed, okay? Except let's talk about Wayfair, Williams-Sonoma, and RH, all right? The old Restoration Hardware. Face it, the furniture at Wayfair is incredibly cheap, and it's good enough. Never used to be a problem that most of it was made in China. Tariffs would simply make their goods more expensive. Nothing else would happen because there's no way to bring that part of the furniture industry back. And even if it could, our products wouldn't be competitive unless they were all made by robots, which wouldn't help anyway. I know both Williams-Sonoma and RH are a different story. They make some fine furniture here, and they'd like to make more furniture, but it's difficult to find skilled workers to make high-quality merchandise. I'm not slagging our workers. The people who used to make furniture simply moved on to other things or they retired. A tariff wouldn't go far enough to make them come back. At the end of the day, I'm skeptical that we can bring back the American furniture industry as we remember it. And even if we could, what would it be worth the cost? I don't know. It's not like a national security need for tables and chairs. Of course, we shouldn't write off the entire industry. Ethan Allen makes about 75% of the furniture here. This stuff's terrific. Maybe the tariffs will give them a leg up. That'd be nice. But unless the federal government wants to get into the business of making furniture, forcing the hand of RH and Williams-Sonoma, it won't make a difference to the industry as a whole. There will most likely not be a revival of those great furniture cities. I feel nostalgic for those cities, but nostalgia is not a policy. Sometimes you just have to accept that the bargain we made had a lot more downside, people's lives who made the stuff, than either party thought at the time. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.